People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as always, zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, you see your friends retire, you see your brothers and sisters retire, you saw how your parents retired, then you go, I wonder how this is going to go for me. Well, let's figure that out. Let's sit down and talk about your specific details of your retirement and how it's going to go. 833-368-3680. Well, on average, we talk about the average Social Security payment, the average amount that people spend in retirement. An average person in retirement needs about $50,000 a year. So if you add that up, $50,000 a year for 30 years, you get up there over $1 million. And so you say, how am I going to get my $50,000? Well, Charisse and I have talked about the 4% rule, which we've kind of debunked. But if you used that, you'd need $1.2 million to get your $50,000 per year. And you go, oh, I don't have $1.2 million. I didn't save that much. Well, you could use a combination of a bunch of different strategies, stocks and bonds and notes and all these different things. But I found an article that says you should look at an annuity, because sometimes you can get your $50,000 a year for less money using an annuity than you can using the 4% rule. Charisse, have you found that to be true?
1,000%.
Really?
So some people have to buy income.
Mm-hmm.
So annuities originated back in the Roman times, right? And then the soldiers retired. They got these pensions for the rest of their lives.
Mm-hmm.
When you retire and you get a pension, it's just an annuity. They're going to give you a check for the rest of your life.
Mm-hmm.
And so nowadays, if you take a little chunk of your money and put it into one of these pension annuity type of plans, it's guaranteed for life. You can set it up guaranteed for you and your spouse's life.
Mm-hmm.
But the older you get, the more income you get because you are buying income. Because a lot of people say, I'm getting older, Charisse, does it make sense for an income annuity, or should I have a growth annuity? Because income annuities typically have a 1% fee. A growth annuity that's in the S&P 500 index has no fee.
Okay.
And so if you save $500,000, that's a lot of money to have saved, right? Because you're going to get a Social Security check, maybe you and your spouse. You're bringing in $30,000 between both of your Social Security checks. And now you have $500,000 that you have to live on. And you say, hey, Charisse, I need another $30,000.
Mm-hmm.
It's going to be hard to pull $30,000 from a $500,000 investment plan if you're following the 4% rule.
Mm-hmm.
And so if you do that and you're trying not to run out of money and you just need that money, that's when you buy an annuity that has an income rider. And just so you know, I'm not always a fan of an income rider. I haven't even offered a client an income rider in years, but a couple of our advisors have, based on what they've seen you've saved. So they're doing it because there's a reason, right? If we need it, if you don't have a pension already, if we haven't saved enough to get us the income goal that we're looking for. So you put the money in, and this is how it's different than a regular pension annuity you get when you retire from your employer. When you retire from your employer, you're going to get a check for the rest of your life. And you might even set it up to where you and your spouse get a check for the rest of your life, right? I always like 100%. After 10 years, if both of you pass away, there is no lump sum going to your kiddos.
Mm-hmm.
So the new age type of pension annuities out there is when you come to us advisors and you're buying this income rider for 1%, you let it grow for a little bit if that's the way you want it. But there's always a death benefit. So when you and your spouse, or if it's just you, turn on income for life, you don't lose your account value. You don't lose your principal. If you die in, let's say, the 15th year, whatever it's grown, because it's still growing, right? It's still growing, which is good news, especially if you got one of the good annuities that's in the S&P 500. There's going to likely be a death benefit there that will go to your kiddos. So we like the new age, the new version, but again, not everybody needs it. And I would say if 100 people walked into our doors this year, for example, there's probably 30 of you that might need it. Again, we like to keep fees down, so we don't want any fees weighing down a portfolio. So if we need to buy income to get you what you want in income to make sure it's locked in for the rest of your life and your spouse's life, then we'll do that. But if that's 30% out of 100%, that tells you that we're not doing that for everybody. Not everybody needs that, but it is an option that is there because bonds, those are there, right? But they're not going to give you what you need in income. If you need 5 and 6% in income, bond isn't going to do it. Money market isn't going to do it. A structured note, it could do it. Sometimes we don't know if it's based on the S&P 500. It just depends. So we want something that's for sure there. So what happens is you have a Social Security check. Maybe you get one of these annuities that has a little income rider on it. We want to make sure your fixed expenses are covered with it. So if you only need to buy $10,000 in income to cover all your bills and you couple that with your Social Security, then you don't have to put that much in there, just enough to cover your fixed stuff. And the rest of your money could actually go into high risk investments, moderate risk, low risk, however you want to, where it's not in an annuity, right? And when you do need extra money, then you can pull it from there. So there is a math equation to who needs it and how much to put into it. And you never put all your money into those things, by the way, because what I've also learned is that when you do get these income annuities, a lot of people don't always turn them on, or they pass away before they turn them on, right? It is amazing to me. So I've learned all this in 20 years. So this is why it's important working with a fiduciary advisory firm, right? Because we understand annuities. It's not for everybody. 25% of my clients do not have annuities, Randy, right? And then there's a percentage that have some income annuities, some that have no annuities, and there's some that have just growth annuities. We like the ones that don't have fees because it keeps your overall aggregate fee down. And I just feel like retirees are overweight in fees and we want to bring them down because you're becoming more conservative. Why did your fees go up? It makes no sense to me. So when you spread out the diversity, you can really get your fees under 1% with an advisory firm, as long as they're showing you all this stuff. And then you get to choose, right?
Yeah.
If you say, Sharice, we don't want annuities, then we don't do annuities. I'm just trying to get you as much as you can get at the safest way possible.
And I think what you've done there is just kind of painted the picture here. We, as that person who's in retirement, know one thing. I need this amount of money to do what I want to do in retirement. You look at Sharice and say, what are my options? There are a number of them out there, and she's just highlighted a whole bunch of them. An annuity might be one of them. It might not be one of them. There might be a lot of other ways to get to that $50,000. But let's explore all of it and figure out what's right for you. You make that decision. That's the whole idea behind retirement and financial planning.
For those people who are listening, a lot of people who have over $1 million saved in retirement, what I see when I do the math is a lot of you don't need those income annuities. And if you do it for a little peace of mind. If you're going to lose a pension and your spouse won't get it if you pass away. So very few of you actually need an income annuity. But I wouldn't disregard a growth annuity as long as it's a real growth annuity, not one of these fake indexes where you're getting the S&P Mark 5 or the S&P low volatility or the S&P, maybe it's a stabilizer. You want an annuity if you're going to get a real good one, in my opinion, a real one that's going to actually pay you with no fee, the S&P 500. And they're very far and few to find out there. And that's why we really only offer about 3 companies, because they're the solid ones that consistently have that allocation. And it's not a fake manager being designed by a designer that knows nothing about you and how you need to make money, but yet they're in these annuities. So there's good annuities, there's bad annuities. And it's always been the story, just making sure you get the right one. And if there's 1,000 out there and there's only 3 we're offering, there is a reason.
Give Sharice a call. Let's talk about how to get you to that number that you need every month in retirement. 833-368-3680 or online, zinniawealth.com. All right, something that might happen to you in your retirement years is you may have some inheritance coming your way. You've heard about the great wealth transfer, all this money that's supposedly coming down. It might not be millions, but what if, mom passes away and she has a house and the house is $350,000 and that comes your way? And then what do you do with it? So I found an interesting article about a brother and a sister. They're in their early 50s. Ellen and Arthur, and they had an aunt who passed away, no children. They got the money, and it was $1 million, and so each one got $500,000. And so it outlined how each of them handled the money. So here we go. So here's Ellen. She pays off her mortgage. It was $280,000, okay? She did some home renovation. Then she had some fun. She went on an expensive cruise. She did a little gifting. But 3 years later, the money was gone. And she's got a lot of equity in her home, which is going to help her for sure, but all the spending money is gone. Now, Arthur, her brother, went a different way. He decided to pay off his high-interest credit cards, all his high-interest debt. Then he increased his contributions to his retirement accounts. And then as he needed money, as gap money along the way, he sort of drew on it, and he's still got a lot of that money left. So obviously, we look at Arthur and say, well, that was probably a better way to go. But tell me, when you look at people who get an inheritance, what is your experience? Do they keep a clear head? Do they go out there and spend very freely? Do they plan for the future? What is it that you see when someone gets an inheritance?
I see more times than not, people spend it. They don't do what their parents taught them to do.
Okay.
It's unfortunate. I wish I could say they do really great with it.
Mm-hmm.
But over and over and over again, I see people inherit money and they go buy that car that they always wanted.
Mm-hmm.
And it also depends on the age. So the younger people, I really feel like do a terrible job with it. When you're retired, I see you do a much better job with it. So it depends on your age and what I personally have seen. And so Arthur, you're talking about, he was responsible. He paid off his mortgage, and then he still had the money there later because it was making money. He added to his retirement accounts or his portfolios, wherever it might be. So he has more money at the end of the day. So he's not cash poor. All of his money is in equity. And if you guys go back to 2007, 8, 9, it was the biggest. Everybody said, no, we want to put all of our money into our houses. Nobody saw a subprime mortgage crash come. Everybody, it was the worst time. I was in this business and so many people's money were just in their house because we were just taught, well, we got the equity. We can pull it out later. And that didn't happen. And people were cash poor, holding their hat, on their hands and just sitting there saying, well, that didn't work out. Would have been nice if we saw that coming, right? And so this is why it's just so critical to work with a retirement planner, a financial planner that does the stock jock stuff, that does the income stuff, that does the full plan, the tax plan, the legacy plan, the healthcare plan, because all this stuff is going to happen. And it's going to happen over and over again in our economy. And prepping yourself and just getting ready for what if factor, I think, is going to be very, very important. When you get an inheritance, don't just go out and go spend it all, because a lot of you might be paying a lot of taxes on this inheritance, right? I'd rather hear the story of Arthur a lot more often than the other young lady, because where's the income coming from?
Yeah.
I always ask, where's that income coming from? And sometimes we just have bad habits. We never get out of those habits. And then you're finding yourself in the same place you were 5 years ago, 10 years ago, because you only get so much inheritance money. And then you're just like, oh, here I go again. Now I'm going back to work, and we don't want that in retirement.
You think about where you would be in your early 50s, and you would probably at that point still be working with a stockbroker. You would be working with someone who's all about growth. So you go to that person and say, what should I do with my inheritance? What are they going to tell you to do? Probably dump it in the market. That's what they're going to tell you to do. If you sit with a retirement planner, they're going to have a whole different viewpoint of how you can help that money build your retirement in the future. So this is one of those times when, it could be as simple of, Cherise, should I buy the car or lease the car? Cherise, I like this town, this place on the beach. Should I buy it? Should I rent it? These are the conversations that come up in retirement. Hey, we found this place that we really like. Should we just go there twice a year, or should we buy this place? Yeah, okay. Let's have those conversations. That's what it is to have a person like Cherise on your side.
And it's timing too, right? Like if you get all this inheritance money and you say, I really want to take this money and go invest it into some housing, and I'm going to buy and sell and that kind of stuff. And the market's high, doesn't make sense. Or if the market's low, doesn't make sense. So it's knowing where to invest that money at wherever we're at in our economy is also going to be key, right? Because rents, probably going to be going down. Houses are, high. It depends if we're in an inflationary period or a deflationary period. There's so many things to look at, because it's also timing, because what you knew 10 years ago very well might not be the best strategy this year, especially if you're going to be responsible with the money. So I think that's important. And for the other person on the other side, the person who inherits the money, that's mom and dad, grandma and grandpa. Hey, if you're worried about your kids buying that red Ferrari you never did because you had a hard time spending that kind of money, then we create really beautiful trusts where you can rule from the grave.
Nice.
So remember that.
Somebody said to me the other day, do you want your kids driving up to your funeral in a Porsche and a Maserati? And it's a pretty good way to look at it, okay? Yeah. Yes, you can have some control over that. Give Charisse a call. Let's talk through those aspects of the world of retirement planning and financial planning as well. 833-368-3680. Again, 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com. You'll see a gold box there. It says complimentary retirement consultation. What does that mean? That means it's a no cost, no obligation look at where you are right now, what you've saved, what you want to do in retirement. Let's put the whole thing together. Do the math on your retirement, as Charisse says. Online, zinniawealth.com. All right, so we've got some stuff going on right now market-wise. Usually we handle this at the beginning of the show, but I just wanted to move it to the end of the show today to make sure everybody gets the opportunity to talk about it. And that is, I mean, we've got a global event happening right now. We've got all this business going on in the Middle East. We've got a midterm year as far as politics are concerned. We've got all the talk about inflation and interest rates. It is a crazy year, and the market is showing it. I mean, we've had a couple of days where it's gone down 1,000 points and then inched its way back up again, and back and forth we go. This is Sarah Malik, and Sarah is talking on CNBC, and she said these years where we have midterms tend to be a little bit more bouncy.
If you look at history, during years where there's midterm elections, markets tend to have a lot of intra-year volatility. On average, intra-year markets declined 18% at some point during the year, during a midterm election year. That doesn't mean it ends up that way, but it means we're going to be in for some volatility likely.
It's always something, as we always say, all right? Okay. Yeah, so, Charisse, is this a year with all of that going on? There's always something going on, but with all of this going on that we're seeing right now, is this a year where we, as investors, we as retirees should pay more attention to our risk level, maybe dial her back just a little bit? Is that something that's happening right now? Tell me about it.
Yeah, if you have all your money in the stock market, absolutely. Because if you're living on that money, and like she said, midterms, historically, if the market drops 10, 15, 18%, and you're pulling money out every month, well, if it goes down 15%, it usually takes about, 6 months.
Yeah.
And then it takes even longer to get back to even. So then we see it take 12 months. So this is 18 months. Your money's going down while you're pulling your paychecks out every month out of your retirement accounts. And then it takes 12 months to get back to even. You're pulling checks out. Hello.
Yeah.
Talk about financial conventional wisdom being eroded.
Right.
This is called sequence of returns risk. This is AKA why people fear running out of money. And then they can't figure out, well, why is my account value not back where it was? I've got the rate of return, and I even got a higher rate of return because we've waited it out so long. But why isn't my account value? Because all the money you've been pulling out as the money was going down, you can't recover that rate of return in the same way out. So it's called sequence of returns risk. It's something that I teach people in our office, and you need to understand it. So if that were to happen, because it's midterms and we have all this craziness out there. I mean, think about it. You turn on the TV and you hear about Lockheed Martin building more missiles. I mean, that scares me, right? Yeah. You have General Dynamics working on their stuff. This is all, Army stuff, right? For those people who don't follow stocks. It's nerve-wracking. Tariffs, Middle East. Like there's just a lot. Interest rates. Most people don't even understand interest rates. They just want interest rates to go up. But what they don't understand is your bond values go down. So you make less money on your bonds. And you're like, wait a minute, I don't even understand any of this. Why am I not making money? And it's important to have a strategy more than a 60-40 portfolio, or more than just an equities portfolio. That's all risk, or more than just a bond portfolio. It's all safety. If you do those things, your retirement's going to get eroded, especially if you're living on your money. And so you have to come up with a plan. And if you don't come up with a plan, you keep doing what you're doing, then there you have it. You're probably going to change the long-term investments that you have. There's probably not going to be as much money going to beneficiaries. And you might even have to change your lifestyle because you're watching your accounts get eroded and you don't understand why. And so most advisors don't teach you this. Accountants aren't going to teach you this. I mean, literally, you have to come here or listen to us to be taught this, because it's not about your money. It's not about fees. It's not about the investment. It's understanding the rules of engagement when you're a retiree and you are living on your money. And that's all it is. And once you understand the rules, then you're going to say, oh, well, then we do need to build this plan. Then we do need to create this. And so I think that's important. So yes, back to your question, in a volatile year, you should have a plan. And not all your money should be in the stock market. Okay. Not all your money should be in annuities. Not all your money should be in cash. Not all your money should be in bonds, right? Not all your money should be in your backyard or you're safe. We want to talk reason, be that mediator that helps you understand why we do what we do, and why, in my opinion, we are really the best at doing what we do. I really, truly feel like we are the best at retiring people early. I don't know anybody who's better than us, and at what we do every day. I truly believe that. And I think per compliance, I'm allowed to say that on radio.
It's your opinion.
It's my opinion.
So here's something that I want to bring up, and that is, you and I have blown up the 60-40 portfolio an awful lot, and all of these different percentages and stuff. And I know that we don't like that, but here's why I like it, because of math. So for instance, if you were an 80-20 investor your whole life, your whole working life, I had 80% in the stock market and 20% in bonds. And then when you went into retirement, you flipped it. And you were 20% in equities and 80% in more conservative and safe areas. If the market goes down 50%, you only lose 10%. See, that math is easy for me to say. If I'm 20-80, I only lose 10% if the market goes down 50%. And that's a risk conversation. I know that's really simplicity and really, but that's Randy math. And, I'm a third grader. So there you go.
It's good, though. It's good, because if you're thinking that, other people are thinking that. Because when we have checks and income coming in, we'll have 80% in equities, total risk. We might have 20% not at risk in bonds. But then when you age into retirement, you pull money out, you're like, no, Charisse, I want 20% in risk, 80% safe. I would say that's a very conservative person. Most people are 60-40, but the moral of the story is this: how do you take less risk and still get the average return that you need, right? And that is all about standard deviation. That's all about your strategy. And you cannot do that in a 60-40 portfolio. So point made, Randy, on the 60-40. You brought me right into that perfectly, because you can't do it. You just can't, because some years you're going to be taking ultimately more risk. Right now, because interest rates went down, your bond values went up. So your 60-40 portfolio, you have more safety and you're making more money. Like, how did you transition your portfolio? How did your advisors transition your portfolio during that time period? I know what we did. We shifted gears in our clients' portfolios and took less risk and they made more money. That's what it's about. That's the key. Active management. And so that is the key. And that's just one of the little baby strategies that we do here. So I think it's really important, Randy, that, circling back, the importance of volatility and time periods like this, because I know you're all thinking it. You're like putting your heads in the sand, hoping nothing happens. And you know what? If you're not living on your income, and you very well can just put your head in the sand and not worry about it. But what if you need that money? You weren't intending on needing that money. I see it all the time. And now you got to sell it. So what is the plan? And so we just want to talk it out, hash it out, put it on paper, put it in writing, and see if we find any holes in your plan. That's the number one here. Are there holes? Have there something that you've forgotten? Is there something you could sprinkle in that could give you maybe a lower risk with a same rate of return or a higher rate of return, or who knows? And so you won't know until you come and check us out.
Let's do the math on your retirement. Here's our number. Give Charisse a call. Take a look at the website and make an appointment today. It's 833-368-3680. 833-368-3680, or the website, as always, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that. You'll be on your way. Charisse, that is all the time that we have on this one. I'll give you the last word.
All righty. Well, thank you all for tuning in as usual. You can go to YouTube now and catch us on video while we're doing our radio show and podcast. You can even see Randy for the first time.
Oh, gosh.
You can go to all of our podcast outlets. And as usual, we just appreciate your time. We appreciate you. We appreciate you coming and seeing us and listening year over year. Live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.